Alright guys, inflation just came out and it was a bit of a mix actually, because we had the CPI month over month as expected, okay, so 0.3%. We had the core CPI month over month a bit below what was expected, but still higher than the previous. So previously it was 0.1, expectation was 0.3, and the actual came in at 0.2. Then the CPI year over year came in higher than expected, so 2.7 from the consensus 2.6, and higher than the previous 2.4. But the core CPI for year over year came in below consensus, but continued to be higher than the previous. So previously it was 2.8, consensus was at 3, and it came actually at 2.9. Okay, so looks like it's somewhat moderating the inflation, because when we look at the numbers, it looks pretty decent in a sense. We had some releases below expectations, we had some releases as expected, and one release a bit above the expectation. But what I would like to point is that all of the releases are higher than the previous, okay? So when we dig a little bit under the surface, when we open the hood to actually see the problem, we find out that the majority of the sectors into the inflationary are coming from tariff sectors, okay? I will break down this for you just in a minute, but before we go any further, I need you to help me just on a very simple way. Literally, putting a thumbs up into this video and subscribing to the channel. And don't forget to join me into the Telegram group, because it's free as well. So you just go into the description, click into the Telegram group link, and you will be redirected to the Telegram, and then you can join me over there. And always on Tuesdays, Wednesdays, and Thursdays, I send the link for the webinar, okay? That the webinar is from 4 to 5 p.m. And today's Wednesday, so we do have a webinar from 4 to 5. And we will be doing high reward, low risk setups, based on the FinLogic sentiment tool. So come with me and I will explain you what is the FinLogic sentiment tool and how you can grab this and start using a strategy ready to use like tomorrow, okay, or even today. Cool, so coming back now for the CPI. According to the BLS, the headline CPI rose to 0.3% month over month, bringing the year-over-year rate down to 2.7, up from 2.4 in May. The core CPI increased to 0.2%, with the year-over-year rate steady at 2.9%, indicating that the persistence of the underlying pressure. So what stand out the most for me was that actually the shelter cost rose to 0.3% month over month, and that contributes significantly to the core inflation, okay? Because shelter alone accounts for over a third, so over 1/3 of the whole CPI basket, and it's persistence, and that persistence that continues to be is a major concern for the Fed, okay? Indeed, we didn't have much change for the CME Fed Watch Tool. I will show that tonight with everyone, but for this month, from 5% expecting 25 basis points cut, now there's only 2% priced in for that. So 97%, nearly 98% expecting no changes on the rates for this year, for this month. So that was widely expected. So what caught my attention is actually when we look for the forward guidance on the CME. So when we look for the last quarter of this year and the second half of this quarter that we are right now on the third quarter, we can present something that is pretty interesting. So the Fed was expected to cut 75 basis points in the last quarter, in the second half of this year. But now is expected only 50, and not only 50, but maybe only 25 with this stickiness of the inflation. Inflation, actually, the headline, if you look at the top of it, it's pretty good. Came down a little bit. Only one release a little bit higher than expected, but previously, yes, higher than the previous, but still very, very on the surface. When you look at it, it's fine. Okay, nothing a problem. But when you dig a little bit, when you go to BLS actual source data, and you see like shelter cost is rising at 0.3% month over month, and is one of the biggest baskets. It's one of the biggest of the basket. So it's 1/3 of the basket accounts only for shelter. Then we have a problem. Okay, so when we go even more deeper, we can see that the transportation jumped to 0.4%, rebounding after the previous softness last year of a sign of a potential stickiness that of the tariffs. Okay, so the tariffs are making the transportation more expensive as well for USA. Also, the Apparel prices rose at 0.4%, and furnishing, okay, furnishing and household supplies increased because these are the biggest ones that are being affected for tariffs at the moment. So that's another signal of services lead inflation broadening again. Now, that being said, what can we expect on the actual market? What can we trade with this data? Well, on the surface, as I say, the market is priced in higher for longer for the Fed. So therefore, soon as the release gets out at 10:30 p.m. yesterday, we had a very mute reaction onto the US dollar index, so the DXY. On the first 1 hour, just a bit of down move, 0.10% or 0.05% down move, and then came back and then sort of consolidated into that area. And after the first hour, so 11:30 p.m., we had a next 4 hours, so until like 3 a.m., 3:30 a.m., a whole move up. So combining over 0.5%, so over half percentage of a full 1% of move up. So that was pretty bullish for the US dollar. And for those who have been into the webinar yesterday, I've mentioned about shorting euro dollar, shorting the pound dollar, shorting the Australian dollar, and longing gold. The only trade we got wrong was long gold, and I don't think it's actually wrong, but it's just the wrong time, okay, to long gold. So as I say, we need an actual explosion into some sense for the capital rotation to come into safe havens, like gold, and we actually have a structural long position and not only short-term longs. And I've mentioned about short terms because I knew something could happen because we don't actually have anything that will change the market reaction and make gold a longer long position, okay? So it's more of a short long in a sense, more of a 1 to 2 hours long position. But euro dollar, Aussie dollar, and pound dollar, all of those three trades are in profit and pretty big profit. So all of those trades combined, they've made over 6%. So 600 pips all combined, okay, not only one, all combined, over 500 to 600 pips. So that's pretty good. So if you are not into the webinar, these are the type of trades you're missing for free. Okay, that's the why I don't get a lot of people not join me into Tuesday, Wednesday, and Thursday. So it's completely for free. That's the type of information you're missing. Now, don't forget, tonight from 4 to 5 p.m., well, this afternoon from 4 to 5 p.m., most of the times morning for you guys, I will be live again. So make sure to join the Telegram group and wait until 4 p.m. that I will be sending the link for everyone. Now, again, what can we trade with this? Well, I'm looking to fade off any sort of bounce back on the DXY. So what I mean by this is basically I'm looking to structural longs positions into DXY. So US dollar, Japanese yen, it's a good long. Euro dollar, yeah, euro dollar is a good short, pound dollar is a good short, Aussie dollar is a good short. So anything that has US dollar, I'm looking to long, and anything that has not US dollar, I'm looking to short. Okay, I will break down more into the webinar, so I hope to see you around there. Otherwise, have a great week, have a great day, great morning, just depends what time you're watching this video, and I see you in the next video, or I see you in today's webinar. See you guys, bye bye.